So what I want to give you on this training is why I like alternatives, particularly real estate, and I call it what I call proximity to your money, proximity to your investments, or degrees of separation from your investment capital. So if you own a business, you run a business, you operate a business as a business owner, you have direct proximity to your money. You took your money and applied it to that business, probably got a loan in addition to that, but you applied your money, you're in that business, you're operating it at some degree. Maybe you're 100% always there. Maybe you've escaped the chair a little bit, you have associates or partners, but nevertheless, you're in there, you captain the ship to some degree or the other. You get to make the decisions. That's direct proximity to your investment. There's essentially no degrees of separation of your money. Let's say you go to the opposite extreme, and to me, that would be Wall Street. That would be your 401ks, mutual funds, individual stocks, bonds, annuities, you name it. Your money is in somebody else's hands. Now, you try to do the best you can to vet it, or you have a financial advisor who helps you read the tea leaves, and you make your best assertion. But my point is, you can't get on a phone call or go do what I call a due diligence trip and go to the company or the fund manager and get inside and talk to them and understand their culture and their philosophy. Can't do that. You're just having to look at outside metrics and hope that this is a company that's well run and hope that it makes sense in the current environment. That's all you can do. So that's what I call several degrees of separation from your money. You do not have direct proximity to those accounts, but it's what most of America usually does, right? That's what we've been taught to do through the marketing machine of Wall Street to tell you that's the way you do it. Most people do it. You're here for a different reason. You want to learn a different way. You may not want to take everything out of Wall Street. That's okay. You want to learn how to step forward a little bit gingerly. You don't want to make mistakes. Got that too. What about investing in alternatives? I call that 1 degree of separation. Unless you're buying a rental property. Now, if you're buying a rental property or investing in short-term rentals where you own the property and you're managing it or overseeing a direct manager, okay, that's again direct proximity, just like a business you would have. Not saying that's a wrong thing to do. If you really want ultimate control, that's what you do. But realize this, there's only so many businesses you can have direct control over. Eventually, you're going to have to pull back and you're going to have to be more passive somewhere, somehow. So decide where that's going to be. Probably for most of us, most of you, in your own business, your own practice or practices, that's where you want to have that direct involvement. Outside of that, you're probably going to need to learn how to do the due diligence, and now I'm going to get to that next, on how you invest with or through other people. It's what we do in Freedom Founders. It's what I do 100% in my life now. When I was in my early 20s, in my 30s, I was directly involved in my investments. I learned a lot. I made some mistakes, but I learned as I went. No regrets. It was the right time in my life. Today, I would not do it that way. I don't do it that way. And most of you from the stories we heard last night, where you are in life, I wouldn't recommend it. Even if you think you've got people in your backyard. If you want to learn that, I'll tell you how to do it. What I'll really tell you to do is how to stay safe, because right now, usually not a good time to buy equity. So you want to figure out, how can I make the most of my capital in alternatives and do it safely, particularly in the volatile environment. But proximity to your capital is a big reason why I think real estate makes a lot of sense. And as we dig deeper and you ask me questions, I'll give you more of that, because that's what you need to hear. You need to understand that, and you need to ask the questions that will give you more confidence to take your next step, whatever your next step is going to be. Look at my notes here. So due diligence. That means underwriting. That means vetting who you might invest with or through. Most people go first for the bells and whistles. They see a promotion for, let's just make it easy, a syndication. You can Google real estate syndications and you'll get page after page after page after page after page. All kinds of people willing to take your money in a heartbeat, and they're all going to present that that all is good, and what they've got is going to give you a pro forma return of double digits, whatever it's going to be, and here's how they do it, and here's our track record, and it's always good. Well, that's the way we always paint what we do, especially if we believe in it. There are a lot of scammers out there, and particularly in the market today, there's a lot of scammers, so just like there is in any industry. So beware, beware, beware. Outside of scammers, there are just people that just don't know what they're doing. And so I just call them, the accidental people who jumped into the game of real estate syndications or funds because there's been so much money made, and there has been a lot of money made in the last 12 years. A ton of money's been made. But those days are over. Now, it doesn't mean that alternatives are out now. Just like You might be a stock trader and you go, well, I can still make money in any market in stock trading if that's what you do. I can make money in any market in real estate because I've got proximity and I've got experience and I know what to look for. That's what I want to teach you, what to look for. Due diligence is critical. You don't look at the asset first. You don't look at the model first. You don't look at the return promises first. You look first at who is the operator. And is it really the operator, or is there a promoter who's promoting the operator? Promoter who does a capital raise, they take their money off the table, and then you're turned over to the operator. Raising capital and operating are two different things. And it's hard for most people to do both well. So usually there's promoters who are good at marketing and capital raising, and they're out the forefront selling the goods, and then you're turned over to an operator. So you really don't know who you're dealing with most of the time. You really don't. The front people may sound good. They may be very, very convincing. They may be very good people, but they have nothing to do with the operations on the back end. There's promoters out there in our field. I know some of them. They're dentists just like anyone else are who took a weekend course on how to syndicate. And what they do is they go out and find other operators, just getting on the internet and saying, operators in real estate. And they say, hey, I'm a doctor, I'm a dentist. I can get inside of forums, of dental forums, and I can help you raise capital because I studied some real estate. I can talk the lingo now. I can talk about cap rates and ROI and cash on cash return and depreciation. I can talk that stuff because I studied it. So they can. But have they actually done it? Heck no. No, they have not even begun to go through a full cycle. When I talked about cycles, not even begun. They have no clue as what they're selling. And again, they're not purposely trying to do anything bad or fraudulent. They believe what they believe because they have no experience. They only have experience in an up market. So they'll promote. What they're doing is they're helping raise capital for somebody else because they've got entree to you, the dentist with the deep pockets and the 401ks and the capital, and they'll go out to you on these forums and they'll talk the talk and they'll be authentic because they're one of us and sounds good. And they've only made money in the up market too. They've never lost anything. It's all been good because they have no experience in the full cycle. And because you don't get a chance to look at a whole diversified table, if you will, of different investments and learn what the differences are, you just go, well, gosh, everybody's made money in real estate in the last few years. I'm missing out. I need to jump on board. And they'll do a webinar and they'll say it's all good, and here's what we do. And you don't know the questions to ask. Well, you don't. How would you know? How do your patients know what questions to ask? They don't. You're, as a good dentist or a good business owner, you help your client, your patient, get the education and ask the right questions. If they don't, you help them ask the right questions. You've got to get in step. Well, these people aren't going to do it. You're accredited. So guess what? The onus is on you. So they really don't have a lot of liability. Plus, if you read the PPMs, the subscription agreements, it's all on you. It's, if this thing goes bad, they got no liability. So it's really easy street for people who want to do that. I don't do that. I don't want to do that at all. Never have, never will. I won't take money by raising capital just because I have entree to dentists. I do it totally differently. I don't take any commissions or payment for monies that are invested in other investments. I don't take any participation in that. But others do. It's not illegal. I'm just telling you what's out there. It's the Wild Wild West. Be very, very careful. But I just want to lay that out for you right now because I know a lot of you are out there thinking you're behind the eight ball. You missed out on all the opportunities, and you've got to get in now. Getting in now, in most cases, you're too late. You're too late. In most cases, we'll talk more about this, but you're too late. So just bear that in mind. Not too late to get involved. Period. No, just in what's being offered right now, you're too late. So be very wary. Be careful of that. Why the deal structure is so important. Oh my gosh. Again, syndicators and fund managers, they just bring you, here's the deal. Here's what we offer you, and we'll talk about what waterfalls look like and returns. But that's typically what's offered out there. What I like to do is be able to be the one to negotiate on the front end. Here's what I'm willing to do. And if I have a small group of investors that I can bring together and go forward to an operator who I know is good, we've got negotiating power. As a single investor, you got none. You just take it or leave it. And again, because sometimes you feel so compelled that you've got to get your money invested in real estate, you just go ahead and do it. You have no idea what the structure is. They'll give you a term sheet, which is just basically a one-pager kind of promising their pro formas. Again, there's no guarantees. And you're just seeing a best position term sheet is going to give you the highest possible return you can get. I always tell my people in Freedom Founders, we have to have our own pro forma. And I help them bring it down to what's realistic. And then even look at a worst case, because you've got to weigh that too. There's risk in everything we do. There's risk in doing nothing. So we have to bear that all in mind. So deal structure. Why you need a competent person, part of your team, and I say your team, you've got to have this, a good CPA tax advisor who understands real estate. most CPAs understand the basics of real estate, but they don't understand all the nuances. And if you're getting involved in syndications and funds with different types of depreciation offsets, with 1031 exchange availability, with using your self-directed IRAs, you're going to need a more competent CPA probably than the one you have. I say probably. You may have one that has that capability. If you do, that's awesome, but most don't. You're also going to need to have an attorney who understands security law. Again, security attorneys, just like all of us, they subspecialize. You know that. You've got to find one that has experience in securities. At least for the first 3, 4, 5 deals that you do, you've got to have someone look over and look at that deal structure and make sure you understand, because there is a lot in those and they bury a lot of stuff, not on purpose to defraud you, but to give them, the sponsors, the operators, the easy out. And I'm not saying that that's wrong, but you need to know what it is. Because again, by being able to know what it is, what it should look like, what your options are, either to not do it, or to go collectively with a group that can come back and say, we like your deal overall, but we don't like this, this, and this. If you'll change that to make it more fair, we'll be in. So again, you've got to have those team members. They're very, very important. Don't just go out there in the Wild Wild West and just believe some salesperson who, again, is just doing their job, just trying to sell what they believe is a good thing. And again, I think most of them believe it's a good thing. But again, have they gone through a full cycle? Do they really understand what's happening? There's a lot of headwinds that are going to be taking down a lot of the operators in the next several quarters. It's happening right now, and we're just at the beginning of it. So again, is this like, oh my gosh, I shouldn't invest in real estate at all? No, I'm just going to keep you safe and show you what we do right now while we're waiting for the opportunities that will come back into the equity, the ownership side, which right now overall is not a good place to be. Overall is not a good place to be. So how do you decide whether it is or isn't? I'll take you through it. I'll show you.